Hey everyone, welcome back to another video. My name is Michael from Lux Trading. Today I'm going to talk about volume. How important is it to use volume in your trading? So I'm going to break down a few aspects that I personally think is important to understand. And if you do enjoy the video, please subscribe to the channel, like it, and with no further ado, let's get right into it. Okay, so getting started here, volume. What is volume? How to use volume indicators? So first and foremost, what is volume? Okay, so it's an important indicator in trading that provides insights into the strength and significance of price movements. Volume refers to the number of shares or contracts traded in a particular security or market during a given period. It represents the level of activity and liquidity in the market. So this is why we talk always about, when you're on your scanners and you're looking to see what to trade, what is the stock that has the most relative volume? Which is a stock that has all the attention? It's the obvious one. That is the one that you want to, do your technical analysis, your fundamental analysis, and have it on a side chart and, watch at the open, right? So this is a little bit about how to use volume, and there's many different ways which we'll get into. So the first one that we're going to talk about here is trend confirmation. A rising market should see rising volume, right? Buyers require increasing numbers and increasing enthusiasm to keep pushing the prices higher. Increasing price and decreasing volume might suggest a lack of interest, and this is a warning of a potential reversal. This can be hard to wrap your mind around, but the simple fact is that a price drop or rise on little volume is not a strong signal. A price drop or rise on large volume is a stronger signal that something in the stock has fundamentally changed. So one of my favorites is bullish signs. Volume can be useful in identifying bullish signs. For example, imagine volume increases on a price decline and then the price moves higher, followed by a move back lower. If on the move back lower, the price doesn't fall below the previous low, and if the volume is diminished on the second decline, then this is usually interpreted as a bullish sign. So just for you to have an idea, we're talking about a bull flag. So basically you have that move up, right, with strength, and then you have that first pullback, which is like a little triangle. And that small pullback, it's with little selling volume. And then the whole idea here, the strategy is to take that first candle to make a new high on the previous candle, and that's your next leg up. And your stop would be on the previous low. Okay, so that's one of my favorites. I always look at volume, but this of course has to be combined as well with some other factors that we'll talk a little bit in the end of the video. Another one that traders tend to look at, and I think it's a must, it's the breakouts versus false breakouts. Okay, so on the initial breakout from a range or other chart patterns, a rise in volume indicates strength in the move, right? Little change in the volume or declining volume on the breakout indicates a lack of interest and a higher probability for a false breakout. So basically, when you think about it, right? Breakouts, I think it's one of the most common strategies out there. I definitely am a trader that tends to scalp these breakouts. But just imagine a breakout. Imagine a stock that is at, let's just say $10. And, we can see that that's like a resistance and it's a breakout point. And it finally breaks out, right? You have to look kind of at the whole context of it. So if it breaks out with strength, with high buying pressure, right? And you see price action holding that level, then, it is most likely that it's going to go another leg up, right? So then you can or buy the breakout at the breakout price, or you can wait to see that breakout. You see the volume with high strength. And then what you're waiting for is you're waiting for the retest of that breakout point, and that's your entry. So it's basically kind of like a micro pullback, and you're buying it for the next leg up, and you sell at the pop 50% and you hold the rest for break even. So, you know, this is important to see the volume, because if it breaks out on another, you know, let's just, you know, the next option, it breaks out and it doesn't hold, right? And when you look at the volume, it's very little volume. Or instead of being very little volume, so it's very low volume comparison to the previous candles, it's not low volume, but it's red volume, right? So now you're like, whoa, are the bears in control of this stock right now, of the momentum right now? You have to kind of synchronize all your eyes on everything, and you have to look at price action, level 2, the tape. You have to be looking at the volume. You have to, you know, see the context in the chart and see if it's holding, right? So you need to get out quick if you see it's not holding and you're a long bias trader. You want to get out quick, but you know, volume is a huge indicator in this case. And for me, at least, when I'm taking a breakout trade, I'm always looking at the volume. Okay, and to end up here, just one last thing, just wanted to say that, you know, it's also important to note that volume-based technical analysis theories are not foolproof, and, you know, it should be used in conjunction with other technical indicators and technical analysis. Traders should also consider factors such as market conditions, news events, fundamental analysis to make well-informed trading decisions. It's essential to educate yourself and practice risk management before making any trading decisions. I hope you've all enjoyed this video. That's going to be it for today. And, you know, stay safe out there, and hope to see you all on the next one. Take care.